Hey, welcome guys. So this is DC. So this is part of our mentorship program. So what I'm currently doing is this. I want you guys to have a taste of our mentorship program. Yesterday we had a very good lesson. We were talking about demand and supply zone. So today's lesson will be focusing on order block, smart money trading. What is smart money concept? What is smart money concept? What are smart money? What are order blocks? How do we trade using order blocks? How do we identify an order block? And many more other things that will be there. So from today, by the end of this lesson, you should be able to use an order block, be it a bullish or a bearish order block. So the focus on today is mainly on the standard order block. So basically that's what we will be talking about. So this is just an introduction to our smart money concept, which is a lot of topics that are there. Okay, so what I'm gonna do now, I'm gonna share my screen so that you can see what is there on my screen. So I've shared the screen and I hope you can see what is there on my screen. Okay, so this group that we currently have the lessons are going to end very soon, and on the 14th of December, that's when we are going to enroll new students. And if you're interested, you can register and we can start the lessons on the 14th of December. So today we'll be talking about smart money concept. Okay, so this information is information that you can Google. You can go on Google and you can easily get. So let's just go through the standard definitions and so that you get a feeling of, or you understand what we are. So we'll be talking about smart money concept. So smart money refers to funds or investment made by knowledgeable and experienced investors or institutions. So when we talk about smart money concept, so in forex markets or in different markets, we have different players. We have large institutional traders. These are the market makers, to say they cause big movements in the financial markets. So we also have us as what? As retail traders. These are small traders. We don't cause any significant impact on the what? On the market. So we have these large, knowledgeable, experienced investors or large institutions. So those are what we call smart money concept. It's a term used to describe the capital placed by individuals or entities with deep understanding of the market. Apart from deep understanding of the market, these guys, they also have large financial muscles that can cause the market to move up and down. Trends and potential risks. Smart money investors typically possesses expert and insights that help them to make well-informed decisions, often seeking high returns while managing risk effectively. They might use advanced analytics, research, or inside knowledge, or to identify opportunities and make strategic investment choices. As a smart money trader, you want to follow the footprints of these large institutions. So when you now decided that you want to be a smart money trader, what you'll be basically doing is this. You're trying, we don't know when these guys are going to enter the market. What we can see are the footprints that these guys have left behind. So as a smart money trader, you want to follow those footprints. You want to trade with these large institutional traders. These large institutional traders, they come in the form of central banks, hedge funds, investment institutions. Those are the big guys that when they enter the market, they have this expect, they have this experience, they have this knowledge, they also have this large financial muscles, they have large capitals. So one of these institutional reference points that we can use as smart money traders are order blocks. So today we'll be talking about order blocks. So an order block is a concept commonly used in trading and refers to specific price area on the chart where significant buying or selling activities has occurred. So as a smart money trader, you can use now order blocks to identify where smart money traders have entered. How do you see this? You observe on your chart where we have significant buying or selling activities. So that's why this theory of order blocks is more effective or more relevant. They are trying to identify where on the chart there's been significant buying or selling activities that has occurred. It's marked by class of orders that create a strong level of support and resistance. Okay, we'll also talk about why is it price will normally come back to that area where there's been a significant buying or selling activities. In some definition, they talk about when we talk about price action in smart money concept in ICT, the difference is this. I used to think that there's a large difference between ICT and price action concept. If you look at price action, we have demand and supply zones. So with smart money traders, they have a specific entry. With price action, they generalize that demand zone. But on that demand zone, there is, yesterday we were talking about demand zone, so this is more relevant. If you attended yesterday's lesson, it becomes more relevant what I'm trying to say now. So the demand zone, on that specific demand zone, with a smart money trader is able to pinpoint exactly where price is going to reverse. Okay, so so we talked about an order block. In an uptrend, an order block might represent consolidation. In an uptrend, an order block might represent consolidation or a pullback where significant buying took place before the price continued upwards, its upward movement. So basically, so when we talk about the downtrend, it's basically the opposite. It could denote a consolidation or a retracement where significant selling occurred before the price resumes its down trend. Okay, so these things you can easily Google and find them. But what I'm gonna teach you now is something that is unique and something probably that you've never heard before. So I've in my lessons I want to be more practical. So we're gonna go to the chart where I will show you so that it becomes easy for you to understand. So we're gonna start with BTC USDT, and we'll be looking at a bullish order block. So these order blocks, they come in two forms. We are mainly focusing on a standard order block. Our focus is on a standard order block. So we'll be talking about the standard order block. And with these standard order blocks, they are in two parts. We have one, a bearish order block and a bullish order block. So we're gonna be looking at how we can identify bullish and bearish order blocks on the charts and how we can use them for trading, and what are the things that we can use to validate that this is a bullish or this is a bearish order block. Okay, so let me quickly go to my charts, and we're gonna go on the 16th of June. We're gonna be using BTC USD on Binance Spot. So let me quickly go to my chart so that we can see what we're talking about. So we'll start with BTC USD, sorry, and we'll be focusing on Binance, this one, and the date is 16 June. So if you go to Binance, you see that it's difficult for you to have the replay mode. But if you come with about 20 minutes, so I'll send you another link so that you can rejoin and we can continue with the at this particular level is this one. We have a support area. Price came to this level, and from that particular level we can see price was bouncing off, so we can mark this area as a support area. So that's one thing that you want to see. And what do you see after that? Look there. signifies that there was the involvement of large institutional traders. For example, this big movement can only be done because of what? Because of large institutional traders. So that's the first thing. So before this big movement, before all these red candles, if I go to the daily, okay, before all these red candles, this signifies that there was the involvement of large institutional traders, which signifies that this is where these big guys entered this market, and if they've caused the price to start moving downwards. So that's one thing that you see. So you mark the last bullish candle, or here on my chart I'm using red and green candles. So the green candles are representing the bullish candles, and the red candles are representing the bearish candles. So the last bullish candle before the price starts to move downwards is our order block. So what you're gonna do is this: you mark, and when you're marking the order block, you only focus on the body. So the candle is a wick, and this there is also a body. So the candle is made up of 4 parts. We have the high, the low, the open, and the close. So you only focus on the open and the close of the candle, or basically the body of the candle. So here, that's what I'm gonna do. I'll focus on the body of the candle and I'll mark it. Why am I marking this area? I can see that at this particular level, there is a possibility that these big institutional traders have entered the market. And for you to know that, according to ICT, he said that these candles, or this displacement that took place, we must have at least 2 to 3 candles times the size of that particular candle that you've marked. And we can see this candle also represent that. So there's a big movement from that particular candle. So that's the first thing that you do. Then you're gonna wait. So what these large institutional traders will do is this: they have large capital, they have large capitals. Probably they've let's just say 1 trillion, and not all of their orders were executed when the price started to move downwards. So we said this red candle, this big movement, was as a result of large institutional traders. But these guys, they were only able to place, or to only use half of their capital, and they caused the market to move downwards like this one. So these guys are smart. Their concept is this: they want to buy at high price, and they want to buy at low price, and they want to sell at high price. So here they were able to only fulfill half of their obligation, assuming that there was 1 trillion. So that means 500 million. Is it 500 million? Half of, yes. Okay, let's just use 1 million. Half of 1 trillion is what? Okay, let's just use 1 million. These guys, they were only able to fulfill, they wanted to place 1 million, 1 million US dollars at this particular level. They were only able to fulfill half of that. That is 500,000. And then not all of their orders were fulfilled as the price was coming down. So they will manipulate again the price to move upwards, tricking most retail traders, because they will see that the price is now bearish, the price is coming down. So most retail traders who have the problem of FOMO, fear of being left out, they will just quickly jump into the trade, assuming that the price is now moving downwards. And then they will manipulate the price again to come back to this particular area. Why? Because not all of their orders were fulfilled. So this is the reason why in most cases price has to come back to the order block. Why? Because we have unfulfilled orders that were not executed. So they want to fill few 100 orders, and only half of that was filled. So they'll manipulate the price to go down and come back here, and then they sell at high prices. So when the price is moving downwards, so what you normally see is that retail traders will place their stop losses just around this area. So let's see what then took place at this particular level. We have the price coming down, and price is still moving downwards. And price is moving downwards. We still have price moving downwards. And what do we see at this particular level? So Go charting, when it comes to drawing, the drawing is a little bit difficult, but it has this nice replay mode which I enjoy using. Okay, so you see price is coming back again to that order block. So when marking an order block, okay, let's just do the proper thing. So when marking an order block, you